Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The Fed has not helped the dollar. Stock indices are skeptical of tech giants. Gold is in a bubble, and the paths of Bitcoin and stocks continue to diverge. The US dollar experienced its worst day in nearly 3 months after the Fed cut its key rate and announced a $40 billion asset purchase program for the upcoming month. The Fed chairman noted that the labor market is cooling and that official employment figures are overstated by about 60,000. Coupled with the Fed's restart of Treasury bond purchases, this lowered yields and triggered a sell-off of the dollar in the market. At the same time, the Fed's hawkish stance materialized. The median FOMC forecast predicts only one rate cut in 2026, and Jerome Powell stated that the rate is in a neutral range, where it neither heats up nor cools down the economy. The Fed feels comfortable in a wait-and-see mode. The likelihood of a key rate cut in January has decreased from 25% to 20%, and the futures market does not anticipate a cut until April. Consequently, the decline in the dollar appears excessive. The Fed managed to please the American stock market by easing its policy and forecasting an increase in GDP from 1.8% to 2.3%, as well as a slowdown in inflation from 3% to 2.5% in 2026, while also discussing the positive impact of AI on productivity. As a result, the S&P 500 experienced its most dramatic reaction to an FOMC meeting since March, and the Russell 2000 set a new record. A strong economy and inflation heading towards the 2% target present a prime opportunity for stocks. Along with increased productivity, this indicates that S&P 500 companies may see growth in corporate earnings. Historical episodes in which the Fed cut rates and markets were near their peaks have shown higher levels 12 months later in every case. However, expectations for the next rate cut have now shifted to April, removing the index's safety buffer. There may be renewed talk of a tech giant bubble, as evidenced by Oracle's shares plunging sharply after the company reported disappointing earnings. According to Yardeni Research, investors should diversify away from the Magnificent Seven and seek opportunities in other issuers, as artificial intelligence is transforming nearly every company into a technology firm. Gold initially responded to the Fed's actions with growth, but then reverted to its original position. If the U.S. central bank pauses its cycle of monetary policy easing, the dollar and treasury yields are likely to increase. This presents headwinds for the precious metal, which is already under pressure due to concerning signals from the Bank for International Settlements and a reduction in geopolitical risks in Eastern Europe. The Bank for International Settlements observes that, for the first time in 50 years, both gold and U.S. stock indices are moving in tandem as risky assets. Their growth is driven by speculation and shows signs of a bubble. The masses continue to purchase stocks and precious metals, while savvy investors seek opportunities to sell or remain neutral. RBC Capital Markets disagrees with this, expecting gold to reach $4,600 by 2026 and $5,000 by 2027, due to rising deficits, declining Fed rates, and geopolitical risks. Bitcoin's attempts to recover are being hindered by structural selling. Cryptocurrency enthusiasts are making titanic efforts to support it, but so far to no avail. Michael Saylor's strategy purchased 10,624 coins for $962.7 million during the week of the 1st to the 7th of December. This was the most significant purchase since July. BlackRock's largest specialized exchange-traded fund, iShares Bitcoin Trust, recorded its best daily inflow of $193 million in the last month. As a result, the total figure for Bitcoin-focused ETFs on the 10th of December was $224 million. Nevertheless, the divergence between Bitcoin and U.S. stock indices is intensifying. Cryptocurrency reacts sharply to news about problems at technology companies, but seems to overlook the market's proximity to its highs. One of the factors behind Bitcoin's fall below 90,000 was Oracle's sell-off. The key events of the third week of December will be the release of U.S. labor market data for October and November, as well as central bank meetings. The ECB, the Bank of England, and the Bank of Japan will have their say. Investors will also pay attention to European business activity data for December. Jerome Powell says that FOMC officials have similar views on the U.S. economy, but differ in their assessment of its risks. Hawks are concerned about high inflation, while doves are worried about the cooling labor market. If employment figures disappoint, derivatives will shift expectations of monetary policy easing from April to March, and possibly even January. This will weaken the dollar. On the other hand, a pleasant surprise from non-farm payrolls will allow the USD to recoup some of its losses. While no changes are expected from the ECB, the Bank of England is 90% likely to cut its repo rate to 3.75%. However, the negative is already priced into the pound, and in the event of hawkish comments, the pound could strengthen. The fate of the yen will depend on the outlook for the Bank of Japan's leadership. Few doubt that the overnight rate will be raised, but what next? Follow the updates on global markets in Pro News Weekly. Like, share, and subscribe.